Meanwhile, the top story right now is bank earnings on Wall Street. J.P. Morgan just reported fourth quarter numbers. They were above expectations on both earnings and revenue. The company generated $25.5 billion in revenue. Meanwhile, banks are bracing for an earnings hit after the tax reform bill. According to the Wall Street Journal this morning, 5 of the nation's largest banks are expecting to report $31 billion in losses total due to special charges that they will take stemming from the tax code overhaul. Bottom line is they're going to be writing down certain assets this year as opposed to next year. The sector will likely benefit over the long run from this tax package, of course. Joining us this morning is FIG Partners Director of Research, Christopher Marinac. Christopher, good to see you this morning. Thanks so much for joining us.
Thank you, Maria. Good to be here.
Characterize what you are expecting from the banking sector as it relates to the tax package and generally speaking for earnings in the fourth quarter.
So we think there will be noise in the fourth quarter from the accounting changes, as you mentioned. I think the market will see right through that. I think the good news for banks is that credit costs are low, expenses are low, and operating leverage is high. The revenue should be growing faster than expenses. We think that heading into 2018, that loan growth is going to accelerate, particularly as businesses now have clarity over the tax bill, and really a lot of the uncertainty of the last 6 months is behind us.
One of the things, Christopher, sometimes when we get in a situation like this, we all assume we know what is going to happen, and we've had these conversations ahead of the earnings, whether it's J.P. Morgan or other banks, that they're going to take these write-downs. The environment's going to improve in the future. But I saw that you said recently we still have to be on our toes, right? So is there anything that surprised you in this report, or if not, something we should specifically be looking for in these other banks that could surprise us with these particular reports? Why do we have to be on our toes?
Well, I think that the pace of loan growth, it gets better as the year unfolds, which means that seasonally in the first quarter, it tends to be slow in January and February and then becomes stronger in March and April. So the first quarter loan numbers may not be that exciting to most investors, and so there is an opportunity for investors to be disappointed in the very short term. My experience has been that the market looks out 6 to 9 months, and that when it does that, it has much stronger second and third quarter results on the loan side. I also think that fourth quarter loan growth most likely is mediocre for most companies, but that's offset by higher margin. The fact that the Fed increased interest rates during the quarter is particularly useful for the first quarter. And in a lot of respects, deposit costs are still very tame in the industry. Depending how the Fed acts this year, that's going to dictate how quickly spreads increase, but we think spreads do increase for the industry.
I just want to point out that one thing that Jamie said in that interview was we are going to be talking about higher interest rates and inflation in the coming year, but it's for a good reason, that the economy is doing better. But he said we're going to be talking about that in the next 6 months. It's going to start. By the way, it did start just yesterday.
Yeah, and you had the big holiday spending in the fourth quarter. You've got the tax cuts now coming into next year. That creates some of these inflation pressures. Christopher, how does that affect some of the consumer credit that we're looking at? We're expecting some maybe stronger earnings when it comes to the credit card business. Do you see that accelerating into 2018?
I do, and that's a great point. I think the consumer credit quality will only get better, which is very good for a lot of banks who do that, and including some banks who are working with fintech companies to buy their paper, which is an increasingly popular tool for banks. The credit cycle for consumers should be very bright in 2018, and I think that concerns about any recession are now completely in the distance. And as we get further beyond the financial crisis, and that's way in the rearview mirror, it's a very healthy time for banks. And I think banks are only going to build capital and have more opportunities to either buy stocks back or do cash dividends or continue to reinvest through M&A.
In fact, Jamie said that he's looking at a lot of different ideas right now in terms of using the money from the tax savings. They could pay out bonuses. He will announce that, he said, at some point, Dagan. But he seemed more poised to do something like helping small business as opposed to giving out $1,000 checks. We'll see. He says he's looking at everything.
Right. It's about reinvesting in the business. It's this similar announcement that you heard from Boeing, for example, reinvesting in facilities in addition to giving employees or making sure that the employees feel the benefits of that. But again, it's a positive. And we have clearly in 2018 the bank's net effective tax rate plummets, and that is a huge benefit to all the financial institutions.
Christopher, what are you expecting in terms of 2018? What strikes you in terms of most important that we should be focused on in terms of the banks and in general, S&P earnings?
Well, for the last couple of years, banks have been slowly but surely getting operating costs down. There are still many regional banks who operate with 60+% efficiency ratios, or the ratio of expenses to total revenue. We think that will continue to fall. We think this is going to be a very important year to drop those expense ratios. Banks are finding more and more ways to either close branches or simply do more with less, and I think that's very productive for the bottom line. We also think that credit costs should be low and that banks have an opportunity to continue to return capital to shareholders. Again, I think that can come in three different ways. You can do M&A, you can do share buybacks, you also can do cash dividends. Cash dividends seem increasingly interesting to me, and I think banks will be talking about that both on this month's earnings calls as well as their board meetings the next few quarters.
Yeah, and even though the investment banking revenue was down, a lot of people are expecting investment banking revenue to go way up in 2018 as we see more deals. With this tax plan, if you were considering a deal, you're probably going to do a deal now with a better profitability story. Christopher, it's good to have you on the program this morning. Please come back soon.
Thank you, Maria. Enjoyed it.
Christopher Marinac.